the video that I wanted to share with you because I missed the class the other day. My voice box was not working at all. So look at this. What you needed to have, we needed to have done in the classes chapter 3 and chapter 6, and then you take the exit quiz too. So you will take exit quiz too, and then take care of these problems. And one of the group needs to take over. I know Al's group was prepared to do chapter 1 and 2, but you can take any group. Please volunteer to take chapter 3 and chapter 6 problems. So analysis of financial statement and chapter 6 risk return. So let me show you the important parts of those. So if I go to the chapter 3 here, analysis of financial statements, basically you will do ratio analysis and DuPont analysis. And so again, we go back here and okay, one more time, we go back here to stress that this is where we are shooting for, and ratio analysis will help us to find out the valuation of the firm. So excuse me. And we had been working with these income statements and balance sheet and other data like stock price, EPS, DPS. So first is there are 5 different ratios you need to have. Liquidity ratio, meaning how much money you will have to meet short-term obligations, and current ratio, quick ratio are the one that are quoted immediately. So if the ratios are higher, you are in a better position. Asset management ratios are efficiency ratios. So again, higher this is better. So this is cost of good per inventories, and industry 6.1, but you are below the industry. So you're not doing too well. And then DSO is days sales outstanding, receivables and average sales per day. The more DSO, that means less efficient you are. So in this case, your DSO is 45.5, in industry is 32, so you're not doing too well. And then this time you go back. So DSO is the only ratio here that we discussed in asset management. That is higher, the worse it is, and the rest of them are higher, the better it is. So it is turnover ratio, how much sales you can make with given net fixed asset, and higher the better. So you look at this FA, fixed asset turnover, total asset turnover, and you compare with the industry, and then you say that, well, because it's higher, one is higher, it is better, but one is lower, it is not. Debt management ratios are the basically financial risk ratios, and then higher the debt ratio, worse your company is. And so, and then this is EBIT, interest expense. That means how many times you can pay your interest with your EBIT. It is 6.3. And industry, you compare with industry, all of those, and you say that this is TIE 6.3, 6.2. It is about the same. So profitability ratio is the last one, and then market book ratio is the market relatives. And so we look at the rate of return with respect to sales and assets. So when it is with respect to sales, it is 3.6%. This is profit margin, and this is operating profit margin, meaning that you do not take the bottom line, you take the midstream cash flow. And gross profit margin is sales minus cost of goods sold over sales, and these are, again, one is net income, EBIT, and this is gross sales minus cost of goods sold. Okay, and so this is you look at this compared to the industry, so the higher the better. And so in 2013, you see it's very bad indeed. And basic earning power is you look at the midstream cash flow and EBIT over total asset. And so BEP is 14%, industry is 18%. Return on asset is now with respect to total asset. Previously, it was with respect to sales, all this profitability ratio. So return on equity is a net income over total asset. Sorry, return on asset is net income over total asset, and this is net income over common equity. So remember, they are higher, the better. So market value ratio are the two ratios are compared, and so we just give me a second. And then so we have price earning ratio, price cash flow ratio, and market book ratio. So price earning ratio, you divide the price per share by earnings per share, and before this, earnings per share is obtained through net income over shares outstanding. And cash flow is net income, and you add just depreciation, and that's what price over cash flow is. And market book ratio, meaning book ratio is the common equity when you in the balance sheet when you add the retained earnings with a price, the market capitalization, and then you get this book value per share. I'll show you in a second. And then you take the market price and you divide it by a book value per share you just obtained, and that's market book ratio. And so all of them, the higher the better. And then for common size, for try we are not going to emphasize the common size. It is the percentage of sales method. You increase all the assets when your sales and liabilities when sales are forecasted to increase. But one thing I would like you to go is to look at the DuPont ratio. It says that, well, return on equity is net income over net income over sales is profit margin, but net income over equity, this is common equity. So if you see net income, if you see common equity, and the rest of them are canceling out, that's return on equity. Now by this they show that, well, return on equity going up is not to be one does not have to be very happy about it, because net ROE can go up when profit margin goes up or total asset turnover goes up. But when this goes up, equity multiplier goes up, it is bad, because what it is saying, it can go up when CE goes down, which means you are financing total asset with lots of debt. See, when CE is low, then it has to be the debt is high to finance total asset. So that is what DuPont system tells you, that it can be window dressing. That is, people can take lots of debt and increase their ROE, but actually they have become riskier. So this is chapter 3 that you need to prepare for. But then chapter 6 is the place where most we introduce to you the capital asset pricing model. So you need to know the difference between the dollar return versus percentage return. So it is the dollar. You receive 1,100 and spend 1,000, you received $100 more, and then you say, no, this is actually return is 10%. So dollar return is not scale. It is scale dependent, but percentage return is not. It is ending value minus beginning value divided by beginning value. So ending value is 1,100, beginning value is 1,000 divided by 1,000. So if you invest 5,000, I invest 1,000. And then if we do return, that means we made it sure that it is just because you spent more, you will get lots of more dollars than I do, yet our returns can be the same. So we look at risk in various ways. One is that you have different scenarios: worst case, poor case, most likely, good case, best case, and you take their probability and multiply with the respective returns, and you later on add them. So this is the way it is done here. You have the probability multiplied by the return, again respective probabilities and return, and add them up, and you get an expected return of 6%. And what you need to understand, that whenever we are dealing this kind of risk, we are dealing with standalone risk, and this is when we figure out risk this way, that was expected return. Now risk is, you take all the probabilities, but this time you take individual return and subtract mean, which you just found out earlier, and square it. And when you do that, you get the variance, and then from variance you get the standard deviation, which is the risk of the standalone risk of the portfolio. Now, we say that, well, this is not necessarily the right way to find out the risk of a stock. So we gave you what is known as capital asset pricing model. And to understand that, we go to this part first. You see, what we see from here, that if I hold only one stock, it would be risk would be 35%. But when I add to it many other stocks, risk started to go down, and at some point it cannot go down anymore. So when you see this, the 35% to 20% it went to. So that means 15% was reduced just by diversification. So we look at these two differences, that is 35%, 20%, and this, we call this part, 20% part, which is undiversifiable or non-diversifiable, is called market risk, because everybody has to share the risk, but the unique risk is diversified away. So what we are responsible for and pay for is 20% risk. And to do that, we say, let's look at the capital asset pricing model. And it looks, first of all, there is a risk premium for market and risk premium for individual stock. So together, you take the risk premium for the market, and this is the risk-free rate, and this is the beta, and we get R sub I, which is the capital asset pricing model return. In our class, briefly, I'll make sure you understand CAPM well, because CAPM is the first thing that gave finance the scientific look. That means it is no longer a descriptive discipline, and you can derive exactly how much an investor requires. And you put these three inputs, risk-free rate, risk premium, and beta, you can get the required return for any asset. Now, you have to do some problems with the capital asset pricing model, and I suggested them, and this is the way it is done. So you take the risk-free rate of 4%, risk premium of 5%, multiplied by beta 0.6, you get 7%. And then there are different other ways that we can look at CAPM. Beta is obtained when you look at the market returns on x-axis, and the stock's return on y-axis, and you get a market, the slope determines the beta, or the riskiness of a stock. Okay, and so please get through these PowerPoints, and also there are you have my videos in there segment wise. Go through the videos, especially for chapter 6 CAPM. Now for the next class, that on April 3rd, we will do time value of money, and then chapter 5 bond valuation. And so you should be, and then I will open up quiz 1 on Canvas for you to do during this week. So you need to bring your calculators with you Otherwise, you'll fall behind. So hopefully this would tell you how to organize the materials uh, and handle the materials for week 2, given that I was absent in the class. Thank you very much.